Welcome to the Investors Podcast. I'm your host, Trey Lockerbie, and today I have with me my friend Andrew Walker from Rangeley Capital back on the show. Welcome.
Hey, Trey. Thanks for having me back, man.
I'm super excited to talk to you, Andrew, because we were talking last June. It was episode 359, and you were informing us not only about SPACs, which was really informative, but also about this merger between Discovery and WarnerMedia. And you did say back then that it would close sometime around mid-2022, which we're going to be there, I feel like, in no time. And there's been some progress that's been made. So I wanted to get a catch up on that from you and see how the merger has been going.
Yeah. So look, I think it's like pretty much playing out on pace. Just this morning, they got HSR approval, which is basically, when you do a merger over about 100 million, you've got to go to the government and say, hey, we're doing this merger. Are you guys, does this raise any issues? Is this, what's a classic merger that's gotten blocked? AT&T tried to buy T-Mobile 10 years ago, and that was a 4-3 merger in wireless. And the government said, AT&T, you're like number one or number 1B behind Verizon. There's no way we're letting you buy T-Mobile, right? So the government blocks them. And you can go to court and say, hey, here's why the government can't do it. But in this case, Warner and Discovery filed with HSR with DOJ. And this morning they said, hey, HSR lapsed, which means the government's not going to try to block this deal. So we're on clear path to close in Q2. And, I don't think anyone really thought there would be a problem, but Time Warner tried to merge with AT&T 4 years ago, and no one thought there'd be a problem there, and the government tried to block that. And over the past 3 months, the Biden administration has been, kind of, hey, we don't want big mergers going through. Elizabeth Warren sent a letter out about this deal saying maybe this is companies getting too big. So it's just it's nice that this is in the past, and now we can look forward to the merger closing.
And just to refresh everyone's memory a little bit on Discovery, back in 2020, nearing 2021, the stock went from around 30 up to 90. It tripled essentially in 3 months. And a lot of that, it comes, we came to learn later, was because of Archegos was leveraging up 5-1 and buying up the stock. And it's since just tanked. And there's been a lot of depressed activity there because I think of this merger and speculation around if it'll go through or not. With this HSR news, as you just highlighted, the stock really hasn't rallied too much today. I'm wondering if that's a signal to you at all.
No, so the way this merger is going to happen is this is a fish swallowing the whale, right? Discovery has a market cap of about $20 billion and probably an enterprise value of $35 or $40 billion. And they're merging with Warner. So enterprise value is market cap plus debt, right? And they're merging with Warner, and Warner, their total value is approaching $100 billion. So this is a real fish that's swallowing the whale. And as part of the merger, AT&T, which owns all of Warner Brother right now, is going to get Discovery shares, and they're just going to spin them off to their shareholders, right? Just spin them off. So every merger where there's two companies is going to have lots of, it's called technical overhang. But in this case, because AT&T's shareholder base is a lot of retail, a lot of dividend-focused companies, I think a lot of people are scared to step into Discovery stock when they know, let's say the merger finishes in June. The day the merger closes, for every 1 share of Discovery that's publicly traded, there will be 4 shares getting spun out of AT&T. Because again, Warner Brothers is way bigger. So I think a lot of people are worried to step in front of this merger when there's going to be this massive technical overhang, because retail investors, the classic thing is, they get a share, or the classic story, I'm not sure if this is true or not, but the classic story people love to say is, if you've got a dividend-focused retail base and they get a spun off a share of something that doesn't pay a dividend or that isn't what they wanted to invest in, they just sell first and ask questions later. So I think a lot of investors are scared to step in front of that technical overhang. And then the other thing is, this is a huge merger. There's going to be a lot of integration. You've seen Netflix stock come from 700 to 400 over the past couple of months. Disney stock has calmed down. I think a lot of people are worried to step in front of both that technical overhang and into a merger that's going to have an integration process. It's going to be rocky. So I think those are the two fears. But for me, I just look long-term, and I think this is just such a great merger, such a killer combination. I think there's so much upside that I think it's worth kind of being aware of those risks and those short-term marks that you could get. But I think it creates so much value in the long term, it's worth looking at.
Now that's interesting because I think last time you were on the show, we weren't clear on how they were going to handle the merger.
That's right.
And
Yep.
now you're confirming they are going to spin off the stock, which to your point might be a red flag because you have all these people who will wake up one day with Discovery stock in their portfolio and say, I didn't want this, and they'll sell it. And so there's that, we talked about the anticipatory anxiety of sorts of, anticipating that sell-off.
And look, this is a classic thing. If you've read Greenblatt's You Can Be a Stock Market Genius, the thing he talks about is on the spinoff, the way to really outperform is find the part of the spin that everyone's going to be puking and nobody wants to buy, and go buy that, because there's so much selling pressure. You can be buying it for a discount. And I think people might be anticipating that's what's going to happen to Discovery, so nobody wants to buy it currently.
And not everyone's bearish on this stock. I mean, Bank of America's analyst Jessica Reif Ehrlich upgraded Discovery recently to a buy, and she raised the 12-month price target to 45 from 34 originally. Do you happen to have a price target in mind? It's currently trading around 28 today.
Yeah, so it's tough because you have this integration, you have this merger happening. It's really hard to know if the key driver of the long-term value here is going to be HBO Max, but we don't know how they're going to roll it into HBO Max, right? Are they going to do the Disney Plus thing where they've got Hulu and then Disney Plus and then ESPN Plus, and maybe you bundle them all, but they're all kind of separate? Are they just going to go whole hog in HBO Max? There's lots of integration. We know there's going to be $3 billion in cost synergies, but there's going to be substantial revenue synergies. We don't know what those look like. So it's really tough. But the way I've kind of looked at it is, you mentioned a Bank of America analyst, which I try not to read tons of sell-side research, but $45 per share is approaching $100 billion market cap. If you look at this company, they said in 2023, we think we can do $14 billion of EBITDA. That EBITDA translates really well to free cash flow here because very CapEx light. Obviously, you need to pay for content, but that's generally through the income statement. So EBITDA translates really nicely, very cash flow light. I think $14 billion in EBITDA translates to about $8 billion in free cash flow to equity. I could be a little wrong. It depends how quickly they pay down in debt and stuff. But, so for $45 share price, $100 billion market cap, that's about 12 times free cash flow. That doesn't seem crazy. And then, I think the real upside in the long term is the revenue synergies, the combined company. It's clear that there's going to be 3 scaled media players: Disney, Netflix, and HBO Max. This HBO, Warner Brothers Discovery, once they're all thrown in. What would you pay for one of the 3 biggest media companies in the world that's completely global, completely scaled, has some of the best brands in the world? I don't see why this couldn't be with a little debt pay down. We know how this company is going to operate. Once they pay down some debt, it's going to be lots of share buybacks, huge amounts of free cash flow. I don't see why this couldn't be a $70 or $80 stock in 3 to 5 years. And from here, I think we're at 28. That would be an absolutely smashing risk reward.
You mentioned the free cash flow. I mean, Discovery has had this 10% free cash flow yield, which is just, again, an amazing number to sit on while you're waiting for the stock appreciation. Obviously, they're not doing a dividend yet. Have you seen anybody buying back the stock?
So Discovery historically has been a huge share repurchaser. You can go read John Malone in 2000. So Discovery was formed from a merger of Discovery and Scripps Networks, right? And they came together, and John Malone, the share price was really weak, and John Malone, famous investor, he went on at Liberty one day. Somebody asked him about it. He was like, I love this company. This is going to be a free cash flow monster. They're going to buy back shares like crazy. And they did exactly that. And I think once the 2 companies come together, they're going to have to do a little debt pay down. They'll emerge 4.5 times levered, which they could run, but I think most people don't like to run 4.5 times levered. Probably 3 is about the right target. But once they hit 3, which they'll do very quickly with the synergies and the cash flow and everything, they're going to start buying back stock like crazy. So every year, the share count's going to drop by 5 to 10% as they depress the share count. And if the stock stays low, they're just going to buy more and more and more until, one day you hit that famous, this is the company that, what happens when they buy back their last share? Maybe they'll hit that one day. And so look, Discovery, again, I mentioned it's a merger of Discovery and Scripps, and it's always traded for a 10% free cash flow yield because people looked at this and they said, what is the terminal value, right? Discovery was all Discovery, Food Network, HGTV, that type of thing. Huge value in the linear cable bundle, but maybe not so much value outside of the linear cable bundle. And I mean that in 2 ways. A, they made all their money from the linear cable bundle, so they need to figure out something to do as the cable bundle count unwound. But then B, you look at what Netflix was doing. Netflix was getting into Planet Earth, right? I think Discovery was Planet Earth and Netflix had like a new Planet Earth spinoff, right? So people would look at Discovery's programming and say, oh, that's really cheap. Maybe Netflix can just roll that out. And over time, like, who's going to subscribe to a standalone Discovery Plus service or Discovery streaming service when you could probably get everything you need from Netflix? And, if you do Disney, they've got the National Geo channel and all that. So I think a lot of people worry about Discovery's terminal value. That's why it's traded so cheap. And the two things that have happened over time, the merger with WarnerMedia solves all of that, right? Because now you're merged into a scaled conglomerate. And I think you combine HBO Max's, there was this article in the Wall Street Journal the other day that mentioned so many people signed up for HBO Max to watch Wonder Woman 1984, but within 7 days, like half of them had left the system, right? The beauty of the HBO Max, of the Warner Brother Discovery merger is people will go to HBO to sign up for the Buzzy series, to watch the new Game of Thrones series, to watch the new Wonder Woman movie. But now they've got all that Discovery background noise, the Dr. Pimple Popper or the Chip and Joanna HD, which people don't think about that, but that's the type of background things that people just watch and binge. And it's really good for reducing churn. David Zaslav, the CEO of Discovery, has this famous quote. I talked to a streamer once and he said, David, if I had your content, I could reduce my churn to zero. So the beauty of this merger is you combine HBO's headline buzz grabbing stuff with Discovery's churn reducing properties, and you're going to get this great service. So I think it really solves all the problems Discovery had. Terminal value problem solved. There's HBO Max. There's all the go forward ways plays. Problems with acquiring customers solved. HBO acquires the customers. Discovery keeps the churn low. So I just think it's a beautiful merger, and that kind of talks to it's historically traded at 10% cash flow because of those reasons, but I think it'll be solved going forward.
Yeah, super interesting. I mean, the market cap's around 14 billion. Enterprise value is almost 26 billion today. This is a theme I think we're going to touch on a lot today, which is really great looking companies trading pretty cheaply and have been for a long time. That's a good segue to focus now on your top 5 predictions for 2022. And prediction number 1 is that value will finally outperform. So let's start with the bear case. Give us an overview, first of all, of why these deep value stocks are so depressed.
Yeah, so I guess if I could step back. So I did this post to start the year, my 5 predictions for 2022. And the first prediction was value outperforms. But everybody always says value outperforms. You can't point to anything. It's very difficult. I'm sure there's quantitative models and stuff, but it's very difficult to go and claim a win on value outperform. So I went a step further and said, specifically, I think in the value sector, retailers and cyclicals are going to outperform. And both of them have something, the thing that both of them have in common, cyclicals would apply steel companies, oil and gas companies, a lot of chemical companies would be in there. Retailers, there's a whole swath of them. It's a broad brush from Walmart to Dick's Sporting Goods to Abercrombie and Fitch. But the thing I was really thinking about with both of them is there's this wide swath of retailers and cyclicals that right now are reporting absolutely record results. And we can talk about why in a second. They're reporting record results. They trade at insanely low multiples. There's a lot of insider buying at a lot of these companies, and a lot of them are buying back shares hand over fist, just like absolutely hammering the share count. And you roll all of those together, and I'm seeing them in lots of different places in both the cyclical and retail sector. And I'm saying, look, that combination, either the world goes to hell tomorrow and these things fall off a cliff, or they're just going to buy back so many shares. Eventually the market has to recognize them. And it just seems like a very asymmetrical trade to me. So I'm happy to talk retailers, cyclicals, or anything in between, but that was my number 1 prediction. And, so far I think it's worked out pretty well.
Yeah, let's dig in a little bit more on the retailers. Specifically, I'm really interested in the sporting goods stores, and there's a lot of these trading very cheaply. So give us an overview of what's happening here.
Okay, so the sporting goods stores, I think there's kind of 4 or 5 of them that are publicly traded. So there's Dick's, DKS, that's the biggest. Everybody knows Dick's Sporting Goods. They're advertising during every football, basketball game that you guys watch. So there's Dick's. There's Academy Sports, ASO, that went public in 2020, used to be owned by KKR. That's really popular in the South. I'm from New Orleans, and the Academy was a 2-minute drive from me. And every time it was time to get ready for, sporting season or whatever, you'd go to Academy. Big 5 Sporting Goods, that's out in California mainly. Sportsman Warehouse, which is mainly on the West Coast, that more focuses on kind of guns and outdoor stuff. And there's Hibbett Sports, which is in more, it can be in urban areas, but it tends to be in a little bit more underpenetrated areas where there aren't a lot of competitors. And there's Foot Locker. So those would kind of be the 5 sporting goods. And all of these, I'm looking right now, the most expensive one is Dick's. Dick's trades for about 5.5 times trailing EBITDA and maybe 6.5 times unlevered free cash flow. I mean, those are insanely cheap multiples. Sportsman Warehouse trades for 3 times EBITDA. Academy trades for 4 times EBITDA. So super, super low multiples. And you combine that with, because the earnings are so strong right now, they're gushing free cash flow, and these guys are hammering their share count. So Hibbett, in 1 month, Hibbett, if you go read through the 10Q, you can see exactly how many shares they bought each month. In 1 month, in Q2 or Q3, Hibbett bought back 12% of their shares outstanding. 1 month, 12% of the shares. I mean, it is insane. So they're gushing free cash flow, aggressively buying back shares. And we could talk about why the market might be trading them so cheap, but I just think that's a mistake. I think these things are really cheap. They're in great competitive positions. Maybe 2021 earnings are a little unsustainable, but I don't think they're falling off a cliff anytime soon.
If I'm just speculating, I mean, is the market sentiment essentially that Amazon's going to eat their lunch and over time, and no one's going to shop retail anymore because of COVID and things like that? Or is there something else?
Yeah, I think there's Amazon. So Amazon risk is always there, especially if you think of something like a Foot Locker, right? Where Foot Locker, they really just exist they're a mall-based retailer for the most part, and they exist to sell Nike shoes. I think that's 60% of their sales, if I remember correctly. So I think people are worried about the Amazon risk. They're worried about, hey, Nike's really growing their direct-to-consumer business. What happens as Nike keeps growing that direct-to-consumer business? And I want to come back to that. So they're worried about all the online and competitive risk, and that's a very reasonable risk. The second thing they're worried about is, hey, in 2021, the consumer was unbelievably flush, right? They didn't really buy anything in 2020. They had all the stimmy checks. They had the stimmies hitting their bank account. So they were going on a huge spree. And I think people are really worried that 2021 results, I'm looking in, just to grab an example, in 2021, Sportsman Warehouse, SPWH, does 150 million in EBITDA. In 2019, they did 60 million in EBITDA. So people are saying, oh, what happens if these things, as the stimmies fade off and everything, what happens if earnings return to 2019 levels? So I think those are the 2 concerns that that the market is expressing. And I'm happy to talk about why I think both of those are wrong.
Yeah. So when people are stuck in their house, they're trying to pick up new hobbies, or maybe going camping. They're, finally buying things like for activities that they maybe weren't in the past. So there's this big surge. And I think the idea is that will kind of taper off now that people are kind of getting back into the world. Is that correct?
Yeah, that's exactly it. So, especially Sportsman Warehouse, right? Academy Sports and Outdoors. There's a lot of outdoors activities, and people say, hey, did these guys, gun sales were going crazy in 2021, but maybe everyone who was going to buy a gun for the next 3 years has bought a gun already. So they're going to have this huge trial for the next couple of years. Or yes, people bought tons of Nikes from Foot Locker in 2021, but now they've got enough Nikes, and maybe the purchases going forward look a lot weaker. So yeah, that's definitely the big concern. So look, I think right now the market's concern, I can tell you, is they look at 2021 earnings and they say that is peak earnings. Earnings are going back to 2019 levels across the board. And I think that is painting it with too broad a brush for 2 reasons. Number one, on the outdoor side, if you are a person who, I'm just going to use a hypothetical consumer. If you are a person who lived in New York City, COVID struck, you took your family and you moved to the burbs or rural or something, and you picked up hunting, you picked up fishing, you picked up golfing, any of those 3, right? You're not going to churn just because COVID had stopped, right? Maybe you move back to the city, maybe you don't. But if you took up golf, you probably invested in golf lessons, you bought clubs. Like, I'm not saying everyone who took up golf, hunting, and fishing is going to stick going forward, but it's a habit. It's a habit and a hobby. Once you form that habit and hobby, a lot of these people are going to stay. So I think their customer base has expanded markedly. You talk about COVID, and you've got these COVID winners who they were growing like this, and then COVID step changed them up. Yeah, they probably come back as COVID normalizes, but it's not back to the original baseline. It's a higher baseline. So across the board for the outdoors, I think they've got a lot of new customers. And then the other thing is, I think the competitive environment has really changed, and it's changed in 2 ways. So Hibbett, which again, they've got a lot of places that aren't quite as competitive. And they say, hey, in a lot of our communities, within a 20-minute drive, there were 2 stores that sold kind of the type of goods we sold, us and JCPenney. JCPenney went bankrupt during COVID, right? So now it's just us. So our competitive environment's much better because our competitors sold. And then the big overarching thing, that's just Hibbett on one side, but I think that does apply a little bit to all of them. But the real change, I think, is Nike in 2018 or 2019, something along there. They said, hey, we're focusing on our direct consumer business. We currently sell to thousands of suppliers, customers, whatever. We're going to cut that down. We're only going to work with 40 of our key suppliers, and everyone else is out, right? So the mom and pop store across the street might not have Nike anymore, but Dick's Sporting Goods still does. Big Five, which is one of the Big Five Sporting Goods, which is one of the companies that talks about, I believe they got kicked out of the Nike program. So, when you compare their 2019 earnings, that's 2019 earnings with Nike. They don't have Nike anymore. I think I haven't studied Big Five as much as I have the other companies, but those sales have to go somewhere. A lot of it goes to the Nike Direct, but a lot of it also probably goes to Academy or Dick's, who still have the Nike stores. So I think the competitive environment is so much better because a lot of the competitors went bankrupt. And of the ones who are still there, a lot of them don't have Nike anymore. And that's huge. Nike's the most popular sporting brand. So I just think the competitive environment for these guys is a lot better. Their customer relationship and their loyalty programs have grown leaps and bounds. Their omni-channel stuff is much, much better now than it was pre-pandemic. So I just think they're in a much better space where they're not going back to 2019 earnings. And by the way, you can also run the math. What if they go back to 2019 earnings? I'm looking at Academy. If we just said they go right back to 2019 earnings levels, treating it 12 times EBITDA and like 15 times unlevered free cash flow, is that crazy cheap for a retailer? No, but it's not like it's the most expensive thing in the world. And by the way, they've opened some stores up since 2019. So their earnings base, you should think, should be a little bigger just because their stores have opened up. So, I just think the market's so concerned about bad comps, but it's not kind of like reading through the complexities of the situation.
So how are you playing this? Are you putting together a small basket of these sporting goods stores? It sounds like you don't have a specific favorite out of the bunch.
Yeah, I'm still really thinking it through. Each of them are different. Like Hibbett Academy is really interesting because they're in the South. I think their stores, and I love their focus on outdoors. Sportsman Warehouse is really interesting because they just had a merger. We talked about HSR when we were talking about Discovery Warner Brothers. Sportsman Warehouse was going to get bought by Bass Pro Shops / Cabela's. And the DOJ said, no, that's too much concentration. In a lot of rural towns, the only places that sell guns are a Sportsman Warehouse and a Cabela's / Bass Pro. If we let you merge, there's going to be rural towns that there's only one gun salesperson there. So they blocked that merger. So I think there's been a lot of forced selling at Sportsman Warehouse, and they got a big break fee from Cabela's as part of the DOJ blocking that deal. So that's interesting. Hibbett, they're just they run the AutoZone model where they just repurchase shares like crazy, very cheap, but it doesn't have that like kind of outdoor piece. One of the things I like about gun sales, leaving the politics aside, gun sales are very insulated from the Amazon risk. Amazon doesn't sell guns or ammo. Walmart and Dick's. Actually, another interesting thing about comping to the 2019 environment. In 2019 and 2020, Dick's and Walmart, who were some of the largest sellers of guns and ammo in the nation, they way pulled back on gun sales. Like Walmart, you can still go get guns, but the selection is really limited. You have to go ask for it. They've got ammo, but again, it's not like front and present, whereas Sportsman Warehouse, front and present. You go there, huge gun selection and everything. And in 2019 is when they started pulling back. And one of the things Sportsman Warehouse said is, look, in 2019, Walmart was liquidating their ammo and gun sales. It was the worst environment for us forever. So if you're comping them to 2019 earnings, you're comping a really bad environment for them. So I like that Academy and Sportsman still have that gun sales piece, which I think is a little bit uneconomically sensitive and, it's very un-Amazonable.
So you're predicting also that we might see some outperformance in cyclical commodities. There seems to be this strange phenomenon happening where there's a lot of these types of companies throwing off cash and even exceeding their quarterly expectations, but the stocks aren't climbing. Talk to us especially about the commodities focused business and what's happening there.
Yeah. So the one I specifically mentioned is US Steel. And what happens is, in the classic thing with cyclicals is everybody says, look, you don't buy them when the multiples are cheap, because that's when they're at absolute peak earnings and things are really good for them. You buy them when the multiples are expensive, because that's when they're at absolute trough earnings and things are probably going to turn around and the cycle is going to resume, right? Well, right now you've got this weird thing where they've had really low multiples for about a year now, right? And so everybody's been saying, don't buy them with low multiples, wait for bad times and everything. But because they've had low multiples for a year and this economic boom, oil prices through the roof, steel prices through the roofs, lumber prices through the roofs, because it's lasted for so long, these guys are minting an insane amount of money. US Steel, I think they made I don't have the numbers in front of me, but 30 or 40% of their enterprise value they generated in cash last year. It's just absolutely insane. So I've been looking at them and saying, okay, I know the old adage, but there's so much in cash coming onto their balance sheet. And, every day that the environment doesn't fall off a cliff instantly is a lot more of their cash coming on their balance sheet. And similar to the retailers, insider buying back shares like crazy. US Steel, as we speak, I think it's trading at around tangible book value right now. And that's for a company that right now is generating 10% of their market cap in cash every quarter. That's a really strange combination. So I just think those are interesting. Oil is a popular one. Oil has gone from 60 to 90 over the past 6 months. Have the oil stocks moved? Yeah, a little bit, but they've probably moved at levels that would imply oil went from 60 to 65. So again, right now, they're just minting cash flow. And it's very strange to see oil, steel, lumber, aside from the fact they're all commodities and maybe a little economically sensitive, they don't have a lot to do with each other. And all of them have the same dynamics where these companies just aren't getting any credit for how much cash flow they're producing right now.
All right, so let's move on to prediction number 2, which is cable stocks, another beaten down industry. What are some of the more compelling opportunities you're seeing with cable stocks here?
Yeah, so I've been a long-time cable bull. Right now, all the cable stocks have pulled back quite a bit over the past 6 months. Charter, which probably is the industry bellwether, has gone from over $800 per share to about $600 per share, which, that's about 25% drawdown. That's a big move for any stock, but for a cable company that should be pretty economically resilient, low beta, that's a really big move. People are really concerned. Fixed wireless competition is coming. T-Mobile was actually the fastest growing broadband company in America in Q4 with their fixed wireless business. They're worried about fiber to the home overbuilds. Every legacy telecom company, AT&T, Verizon, Frontier, Lumen, all of these guys are trying to upgrade their legacy copper DSL to fiber. So people see lots of competition on the horizon for cable, and they've been selling down the stocks. I've actually been doing a series with Tegas with expert calls and diving into the cable. But my base case has been, these concerns have been around for years and years and years, and they haven't really impacted the cable companies. And my base case continues to be the cable companies are going to continue to perform just fine going forward. They are gushing free cash flow. They are buying back shares like crazy. They're very well run. They are growing. And I think this year, the combination of that continued growth in cash flow and the share buybacks is just going to be too powerful of a story for the equity market to continue to ignore. And then the other interesting aspect is we've seen transactions in the space. So there's a publicly traded overbuilder, which an overbuilder is the company who comes in and, there's already a cable system there and they say, let's build a second cable system. And that's a very poor business because it's not a monopoly. It's at best a duopoly. And if there's a fiber to home payer, it's a triopoly. But it's a poor business, but it makes cash. And once the assets are there, the assets are there. WOW sold a bunch of assets for 11 times EBITDA over the summer. And right now, Charter, Altice, Comcast, the implied prices of their business is lower than 11 times EBITDA. So that's a worse business, a worse asset, and the assets that WOW sold that went for a premium multiple. And we've seen kind of normal cable assets tend to trade for 15 to 17 times EBITDA. So, we don't have to do the math here, but 15 to 17 times EBITDA on these stocks would it'd be a hefty premium from the current levels. And Charter and Comcast in particular are much, much better assets than a lot of the even normal cable assets that are selling for 15 to 17 times EBITDA. The only other thing with cable is people are really scared about the looming competition, fixed wireless, fiber to the home. And again, that's been there for years and the cable stocks have done well. And I just did a series on discussing all the risk and people can go look at that if they want to really dive in. We talked to the former head of the FCC, telecom industry experts and everything to frame that. But so I don't want that to, But I do think people really dismiss the wireless opportunity that these cable players have. I think they've got a great opportunity in wireless. Charter and Comcast are growing their wireless business basically as fast as Verizon. And, Verizon covers the whole nation, and Charter and Comcast each only cover a third of the nation. So for them to grow that fast says that there's a real value there. And you can see why. Charter right now, you could go sign up for an unlimited plan with Charter. And if you had broadband with them already, adding a mobile line with unlimited would cost about $20 per month. So, broadband's about $50 per month. A wireless line from them is $20 per month. You probably pay about $70 per month per line for your mobile service right now. So they could save huge amounts of money if you get broadband and wireless from them. So that's why I think it's so powerful. I think they're going to take huge share in wireless going forward. And as they do that, Comcast's wireless business just hit profitability in 2021. Comcast will in 2022. So right now, when I mention earnings multiple, they're a drag because they're investing in them. And as you grow a mobile business, it shows losses. But once it kind of hits stability, it'll be profitable. Once they hit profitability, I think people are going to be really surprised by how profitable these are, how quickly they're growing, the opportunity there. And I think when you add that in, the cable stocks are even cheaper than they appear on the surface.
Yeah, again, Charter especially looking just really interesting. Market cap's at 105 billion today. Enterprise value is at 196 billion. And just kind of an interesting observation there. Let's go on to your third prediction, which is that the COVID winners will win again. I want to focus especially maybe on Peloton because that's become a bit of a meme as of late and almost this poster child for a greed and fear index. What is the bull case for Peloton moving forward?
Yeah. So I guess I should caveat by there's if you talk to someone and they're like, oh, I love this stock. And you ask, hey, do you have any money? And they're like, no, I don't own it. That's one thing. But if you talk to them, they're like, yeah, it's 20% of my portfolio. That's another. The first two are ideas and themes I've done a lot of work on, I really believe in, and we're invested in pretty significantly. The next three things we're going to talk about are things that I call it mouth betting, where I've got a belief, but maybe it's not so firm that I'm ready to put money in there. So I'll just caveat with that. But Peloton, I look at this company, it's gone from $20 pre-COVID to $150 at the height of COVID winners winning to $30 or $35 today. I look at it and say, hey, this is a business. It's not like all the subs they gained during the pandemic just go away magically, right? People got Pelotons into their home. They paid for them. They spent thousands of dollars on them. They form a relationship. Peloton, people who love it, it becomes like a cult with them. They're using it every day. So I look at all that. I look at a company that trades, if you just look at the subscription revenue line, the consumers, they're growing. I look at what it trades for. It trades, I think last I checked, about 8 or 9 times subscription revenue, which is very cheap for a subscription company. I think they've got all sorts of optionality, and I think the market's got a little too pessimistic on Peloton, Stitch Fix, Zoom, companies like this, where their consumers love them. COVID was a big benefit. They were big COVID beneficiaries. And there's lots of tangential opportunities that they might be able to capture because their management teams are hungry and because consumer loves them. Like Peloton, the classic is at some point, Peloton's going to have a giant apparel business, right? And why couldn't Peloton get into, I don't know, restoration hardware, got into doing hotels and stuff? Why couldn't Peloton start opening Peloton branded gyms, Peloton branded hotels, Peloton branded lifestyle stuff? I'm just spitballing, but I'm just saying these brands that consumers love have so much optionality. And when I look at the stock price and how depressed the market is on them, it doesn't seem like the market is recognizing that. And by the way, they're also probably pretty strategic. You heard the rumors that Apple, Nike, Amazon, whoever might be looking at Peloton. There's nothing quite as strategic as somebody who's bought $2,000 to put a product into their house that they're going to use 5 times a week or something.
Yeah, the acquisition thing is really interesting. You saw Lululemon purchase Mirror, for example, for $500 million. It makes sense that some of these companies might be taking a look. I'm not so sure I buy it yet, the speculation. Do you see much merit in, say, someone like Amazon actually purchasing Peloton instead of, developing their own?
Yeah, look, I think it's really tough to go and build your own thing. People like to say, oh, a Peloton is just a bike with an iPad on it, right? if you've ever used a Peloton and then used like any competing spin bike, it's night and day. Like people used to say Tesla, oh, why can't the ICE companies do this and stuff? Well, have you driven a Tesla? Like, it's really nice. The people who do it love it. I'm not saying the stock's under or overvalued here, but these things where it just works and it works like magic are really hard to recreate. And there's also a little bit of a land share grab, right? Like, I have a Peloton in my house now. If Amazon rolls out Amazon Prime Bike, even if it's the same or better than Peloton, I'm not going to get rid of my Peloton. Now, if they gave it to me for free with my Prime membership, maybe. But I also have kind of a relationship with the instructors I love and stuff. Like, those things are very sticky. So I do think when you look at these things, like if you're a company and you look at Peloton strategically, you can say, okay, millions and millions of members who use this frequently, we get all sorts of data on them. We have a product that they're using frequently in their house. Like, why did Amazon want Alexa and Echo and these things? Because having something in your house that you're frequently using is the best form of building customer habit. Having a Peloton in somebody's house, there's lots of interesting ways you could use that as optionality. You could have Amazon Prime shows on there. You can do product integrations. There's just like lots of endless opportunities there for them to dream big and think of ways to integrate it, bundle it into the Prime membership as an extra benefit to get more people in Prime. There's just lots of things there that they could do. And by the way, again, 10x revenue, 8 or 10x revenue for subscription revenue for a very sticky service. Like, that's probably cheap in and of its own right.
Talk to us about why the stock fell out of bed. It was trading up around 80, 87, and then it woke up one day and it was in the 50s, right? So what exactly happened? Did they miss some earnings? They've obviously lowered their forecast a little bit, but what happened here with this huge, almost 60% drop?
So you and I are talking on, what is it? It's like Wednesday, February 8th or 9th. We just found out yesterday their CEO is stepping down. He's going to become the exec chairman. They hired a new CEO. I think what happened is mismanagement. In March 2020, demand for Peloton went through the roof. And for the rest of 2020, Peloton was trying to catch up, right? I got my bike at the end of 2020 and it was like 8-week wait time. They were trying to catch up with demand far outstripping supply. They bought a bike manufacturer. They were ramping, hiring like crazy, everything, right? And then, around the middle of 2021, demand starts to normalize and they just bought all of this supply. So now they've probably overinvested in supply versus demand, right? And along the same time, they're facing a lot of other issues. They have the Peloton treadmill recall, which I think was handled abysmally. In Q3, they come out and the stock's at 70 and they release earnings, which are a huge disappointment. They're pulling down guidance and everything. And somebody says, hey, like you guys, you've got a lot of fixed costs. You've got a lot of investments. Do you guys need capital? And the CFO, if I remember, said, nope, we don't need capital. 3 weeks later, they go and raise equity, right? So it just all speaks to a company that was mismanaged. I know John Foley, who was the CEO, he built this business after tons and tons of venture capitalists turned him down, said it was a silly idea. So he had some vision, but I think he was mismanaging it towards the end. They were kind of running from one fire to another. I think they burnt a lot of their credibility. And look, it has not been a great time in general for like kind of the COVID winter stock. So I think that all explains how we went from $80, $90 to 30, 35, wherever we are right now.
Okay, let's move on to prediction number 4, the law of large numbers. What high flyers do you see falling and what high flyers now seem maybe reasonably valued here?
Yeah, so again, this is not one that I've got like insane conviction in, but I just look at how Apple, Amazon, a few others are up like 30% every year, it seems like. And at some point, the large of law numbers has to catch up to them, right? Like Apple's market cap can't be 15x the entire global GDP or something forever, right? And I just kind of thought this was the year because you look at them and a lot of them don't look cheap anymore. 5 years ago, Apple's P was like 10 or 12 times. And today it's like 30 or 40 times. I haven't looked post the numbers, but the multiples have expanded quite a lot. There is a lot of interesting competition and regulation that's coming. We talked regulation and Discovery, Warner Brothers, but regulators do not love Amazon and Apple size and everything. And there's always things with break them up and everything. And in the short term, that might not matter, but in the long term, like that's a headache. Look at what happened with Microsoft in the early 2000s. Like management's distracted. You can't do everything. It's really tough having that regulatory scrutiny. So multiples are higher. I think regulators are coming. I think there's a lot of looming competition in some of their businesses. And I think you just put it all together. And I'm not saying that these things are going to go down 75% overnight, but I do think like they can't keep delivering market beating returns forever. And combine all that with rising interest rates, which, 40 times PE on some of the largest companies in the world. I think part of that is the fact they can borrow money at 2% and buy their shares back. If interest rates actually did rise, I think you get some some PE compression from that as well. Combine all those, and I think you've got the market for some stocks that kind of stall out over the next couple of years. And then the other company I mentioned was Tesla, which, has just an astronomical valuation. And people have been saying, competition is coming for Tesla for years and years and years. But I do think at this point, you are finally seeing, you've got the electric F-150 and all of these things rolling out. I think you're finally seeing progress on the competition side. Not to say Tesla's going to go down 75% or something. It can't keep, it was up like 12x from 2020 to the end of 2021. It just can't keep growing like that.
I'm glad you brought up Microsoft because it seems like they've kind of broken through that regulation scrutiny you mentioned, because they just announced a $69 billion acquisition of Activision Blizzard. And I think back in the 90s, to your point, something like almost $70 billion acquisition would trigger a lot of concerns from the DOJ, et cetera. But they seem to be moving without that kind of friction anymore. What's your take on that?
Well, I think you're right. Microsoft, I remember a great tweet from a couple of years ago that was like, the bull case for Microsoft is they're the only mega cap tech company that can do M&A anymore, right? And when the government was going to force TikTok to divest, Microsoft was the only company that could buy them, right? So I do think that's true. But to your point on regulation, Microsoft, it's buying Activision. If you look at the spread, I think they're buying them for like 90 or 93 in cash or something. As we speak, Activision is below, it's at 81. So it's coming a little bit, but that's still a big, big spread for a cash merger with the most credible buyer in the world. Microsoft's going to take the cash off their balance sheets to pay for it. The market is saying there's a good chance that regulators are going to step in and try to block Microsoft Activision. So even Microsoft's running into problems with that. But yeah, as you said, they're buying Nuance. They're doing lots of M&A. They're the only person out there who it seems can acquire. I thought somebody put another funny thing out there. Facebook tried to acquire Jiffy or whatever, which makes, GIFs, and they got blocked. And that was like a $200 million acquisition, but they can't buy Jiffy, but Microsoft can buy $70 billion Activision Blizzard. Like, is that serious regulation? It's just kind of hard to believe.
All right. So moving on to prediction number 5 around SPACs. Last time you were on the show, you gave this very informative introduction to SPACs, but you're now writing that there's been this SPAC bubble that has burst. So what's your outlook on SPACs nowadays?
Yeah, so I think you and I talked in June 2021, which the height of the SPAC bubble was February and March of 2021. And by June, it was very cold. And since then, I'd say it's gotten even colder. But what I've always loved about SPACs is if you buy a pre-deal SPAC, so you buy a SPAC, most SPACs have about $10 per share in trust. You buy a pre-deal SPAC, they announce a deal, and you just hope, hey, they announce a deal and the stock market goes parabolic for the deal. And the best example of that would be DWAC. That's the SPAC that's merging with Trump's fledgling social media network, right? And the day before they announced that deal, the stock was trading at or below trust. So it was trading around $10 per share. And as you and I are speaking, it's trading at $84 per share. Now, unfortunately, I wasn't involved in that one. I would have loved to be involved in that one. But that's obviously an extreme case, but that can happen, right? You buy a SPAC, you buy it below trust, you hope they announce a buzzy deal that the market loves and it goes crazy. Rumble, another social media network's coming public through a SPAC, and every time they tweet about Joe Rogan, the stock price goes up another 10% or something. So you just hope you get lucky and that happens to one of the SPACs. And if it does, you're going to make an outstanding return. And if it doesn't happen, well, you bought the SPAC, you bought it below trust. And I can give you some examples, and it'll liquidate in 6 or 9 months. So you'll make 1 or 1.5% of your money because you buy it at $9.85 and it'll liquidate for 10. So you make 1.5% of your money in 9 months. And is that the best return in the world? No, but it's a hell of a lot better than what you would get if you just parked it in like a cash account or something, right? And So you're doing better than a cash account for a cash. You're getting a better return than cash with cash-like risk, with the added optionality of if you bought it and the stock went absolutely bonkers.
It's interesting. So last I checked, there's around 500 or so SPACs, and there's still around $900 billion private companies. So 900 unicorns to choose from that you think would all want to go public. So it's not like there's not a lot of opportunity. Is it that the private sector is saying, hey, we're good right now? They don't necessarily want to go. What's the stall out? Where's the stall out coming from?
So a SPAC is, you go and raise the We Study Billionaire SPAC, right? And you get $200 million and you throw it in a bank account. And then what's going to happen is you go try to find a company to merge with, and you'll come and present it to your shareholders and say, look how great this deal is. Approve our merger, give us our $200 million, and this will become a publicly traded company. But the reason I, as more like a kind of trader, like SPACs, is you get the free look at it, right? You come to me with a deal. If I love it, I can keep it. If I don't, I redeem it and I get my money back. And the reason unicorns aren't going public through SPACs right now, everyone knows when a SPAC finishes its deal, the stock's going straight down. So everyone is redeeming. So you'll see actually Treb, TREB, merge with a company. I'm forgetting what the ticker became. I'm going to look it up as you and I are talking. It became System 1, SST, right? And that was like a $500 million SPAC. And I think 99% of shares redeemed. So if it wasn't for outside financing, we can talk about that in a second. When they merged, they were like, great, we're getting $300, $400, $500 million, whatever was in trust. When they went to actually collect on the trust, there was only like $3 or $4 million left in it. And what company wants to go through all the headaches of a merger, all the expenses of a merger, and find out at the end that there was only $4 million? It costs more to do the merger than they're actually getting in some of these cases, right? So nobody wants to go through that. So right now, every private company is hanging up the phone if a SPAC sponsor calls them, because they're saying, I'm going to go through all this headache, and at the end of the day, there's not going to be anything left in trust, and my stock's going to trade like shit once it goes through. So they're just hanging up the phone on them. We can talk about the exceptions to those rules if you want, but that, people say, oh, these SPACs, 200 million in trust, there's lots of targets. Yeah, but no credible target wants to take your money because they know there's no money once push comes to shove.
Now, I know Rangeley was big on the Planet SPAC that has, essentially busted from the start. Is this what we saw there with the redemptions? Is that what's happened in that case as well?
Yeah, so Planet, so that's more my partner, Chris. Chris has a really good relationship with Nicolo, and Planet is a really interesting company. I can't claim to be a full expert there. I'd have to defer to him. But I think what happened there is, look, so Planet is different because they had a super credible sponsor. I believe he actually has done, his SPACs have done the best of anyone. Super credible sponsor, super interesting company. We should talk about the financing in a second, because I think financing is a real key to SPACs going forward. But what happened is that merger completed, and I think the stock was at 11 and people were really excited, and it completed in like September or October. And then since it completed, every growth company in the world has fallen like 50%. And Planet, I think, has kind of been falling along with them. I don't think that is, again, it's a unique case where it's a real company with real sponsors. I just think if you were a 30x revenue company over the summer, you're a 15x revenue company today. And I think they just got caught up in that trade.
Got it. Let's talk about the financing issue you brought up with SPACs. What's happening there?
Yeah. So I mentioned how if you're a SPAC and you've got 200 million in trust, you go merge with someone, and at the end of the day, you're going to deliver 2 to 4 million. I think the only way SPACs are getting deals done going forward, and actually there was a SPAC that called off a deal today, I'll talk about in a second, but the only way SPACs are getting deals done right now is if they've got a sponsor who's going to commit a serious check to the company, right? So you look at, we talked about Pershing Square Tontine last time, which unfortunately that deal was blocked by the SEC, but they've always had an advantage where Bill Ackman's fund is going to write $1 billion check into whatever deal they get announced. So even if you go public through Pershing Square Tontine, even if everyone redeems, Bill Ackman has written $1 billion check. There is a pot of gold at the end of that rainbow, right? I just mentioned Treb, which merged with System 1. 99% of shareholders redeemed, but they were backed by Cannae Holdings, which is Bill Foley's kind of like quasi hedge fund merchant bank. And Cannae backstopped a ton of these redemptions. So if it wasn't for that backstop, the company would have only delivered $5 million in cash on the back end. But because of the backstop, they still got hundreds of millions of dollars, right? So I think for a lot of these companies, the trick is having a sponsor who's going to kind of put a check and put his money where his mouth is. And MBAC, which had a merger that got called off this morning, it got called off because too many shares redeemed. And I believe in the press release, they said, hey, we're going to go try and find another SPAC deal, because if your deal fails, you still have a little bit of time left to go try and find another SPAC deal. And they even said, we're going to try and find another deal. And in our next deal, we're going to have so much committed financing that even if everyone redeems, we'll be able to get the thing going through. So I think like for SPACs to get deals done now, committed financing is the name of the game. But a lot of the SPAC sponsors who raise money at the height of the boom, they just don't have access to that much committed financing. Like not a lot of people can write $200 million checks to cover redemptions.
So are we talking now that SPACs are totally dead in the water, or are you still seeing some interesting opportunities in the SPAC world?
Yeah, so I think there are two really interesting places for SPACs right now. The first is, I mentioned go buy a SPAC below trust, and you're going to get cash or above cash-like returns with that added optionality where if they announce the Trump DWAC merger, the stock could go parabolic, right? So a couple I like on those lines. So IPOD and IPOF, which are both some of Chamath's SPACs. I'm sure everybody knows who Chamath is. They trade, as we talk, around $9.90 per share. Trust is 10, so they trade for about a 1% discount. And they've got till October to announce a deal, right? So if they don't announce a deal in the next October is that's 7 or 8 months from now, you're going to make 1% over 7 or 8 months. Not the best return in the world, but it's not the end of the world. Everyone should consult a financial advisor, not financial advice. But unless you think like JP Morgan is committing fraud on these trust accounts or something, right? You're going to make that 1%. So that's your downside. And your upside is, look at every SPAC that Chamath has launched. Most of them go parabolic once he announced because he knows how to find buzzy targets. The IPOF has been rumored to merge with Discord, which I think would go crazy if he did it. There are plenty of other buzzy SPACs out there. What if you're invested in the SPAC that merges with Starlink, if that came public or something, or SpaceX or something? So I think you get lots of optionality. So IPOD, IPOF, I could see something buzzy happening there. SoftBank has a SPAC, SVFA, that trades 2% below trust. It has until January to find a deal. So a little bit less than a year for a 2% return if they don't announce a buzzy deal. And who knows if they announce a buzzy deal. And then CONX is Charlie Ergen of Dish Network, Dish TV fame. That's his SPAC. It trades about 2% below trust, and that's got till October. So again, 7 or 8 months, 2% return if he doesn't announce a deal. If he does announce a good deal, and Charlie Ergen is famous for being a good negotiator, good at M&A and all that. If he announces a super buzzy deal, who knows what happens to the stock, right? So I like those. And then on the other side, I don't have a particular example, but I've been looking a lot at de-SPAC. So these are companies that have already gone public through a merger. And the beta for companies that went public through a SPAC right now is 1. They all just trade straight down together. And I think you can find lots of interesting examples. So I recently wrote up XL Fleet, which was one of the buzzy electric vehicle SPACs. That trades for $2 per share right now. They've got about $2.40 per share in cash on their balance sheet. So that's trading below cash. There's a lot of other SPACs that trade for very, very low multiples. I think those could be interesting. They're screaming for an activist to come in there and kind of liquidate or sell the company, right? And then the other area, so Iron Source, IS, is an interesting one. It's a real company. They came public through a SPAC. They're growing like crazy. This year they're going to grow 60% with 35% EBITDA margins. It trades for about 10x forward sales, so it's not the cheapest thing in the world, but it is a real growth company backed by, went public through Thoma Bravo's SPAC, which Thoma Bravo is the best private equity software investor in the world. They put in like $500 million into the SPAC at deal price at $10 per share to get the deal done. So they wrote a $500 million check at 10, real company, real growthy. It's trading at $7 per share right now. Again, I'm not an expert in the space, but that type of thing where you've got a real sponsor who put tons of money into it, knows the space well, and the stock's trading well below it. I think that's a great place to look for opportunity.
Well, this is why I love talking with you, Andrew, because you're just full of these amazing ideas and you've given us a lot of homework. I'm going to go study all these things and check them out and dig into this more. And For those who don't know, you write an amazing blog with a lot of these ideas featured there. So why don't you go ahead and give people a handoff where they can read about this stuff, follow along with what you're up to, and any other resources.
Yeah, that'd be great. So my blog is yetanothervalueblog.substack.com. And we've mentioned a ton of the stuff I've done on there. I had a write up on XL Fleet. I did the cable Tegas deep dive series. We talked about my 5 predictions for 2020. And then if I can do a competitor, I also have Yet Another Value podcast, where I have a lot of the guys that you've had on here come on and talk about kind of their best and most convicted idea. It's an hour, just deep dive into a stock idea. And, it's not for everyone, but for people who love stock ideas, it's good stuff.
No, it's a fantastic podcast. All right. Thank you so much, Andrew. Let's check back in, especially see how this merger goes with Discovery and some of these other SPAC opportunities. Super interesting. Would love to catch up with you sometime soon. Thanks again.
Hey, love to come back on. Thanks so much, Trey.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.